Good morning, everybody. Kirk Spano here, retirement income options and stocks of the week, although we're going to cover some ETFs as well. So very quickly here, I am in the process of updating the February options expiration update. Have a couple of trades that I mentioned. I sent this one out on Friday, still available today. Selling puts on Occidental Petroleum. Why? Same story as every other week that we've told it. Warren Buffett's buying the stock at around $60 a share based on his warrant prices. There's a little bit of headwinds into the market right now. So that means that you can get Occidental for below the warrant price that Berkshire has, which is $59 and change. If you really want to own the stock, you can certainly do that. I have done that in a couple of accounts, but mainly I am selling the $60 May puts and getting over $5 a share for them right now. So it is a spectacular premium, over 8%, almost 9%. And worst case scenario is you end up owning Occidental shares at 55 net of the option premium. If you want to lower your potential assignment price, then just use the $55 May put and you'll only get like $2.50 or $3 for it. So you'll get less premium, but less likelihood of having it put to you. And if it is, it's at a lower price. I like the 60. New Fortress Energy, I updated this. You can sell some puts on that. It really has been holding up well in the middle to upper 30s. That might be the bottom at this point, given that it's just such a strong company. Great growth in the right part of the market, unique technology in liquefied natural gas, and the transition over to hydrogen they've already started on. So I can't see anything wrong with owning this one at a net cost of 33, even though I think our bottom fishing is 31. Ford, all the EV companies are, running into the same issue right now because they're trying to ramp up and simultaneously find the resources to do it. Technology is no longer a problem. Batteries are getting better. Now it's just a matter of how can they sustainably source the materials they need. Most of those prices are firm. It's just a matter of, how do they get their lithium? How do they get their iron? How do they get their nickel and whatnot? There was a hit piece from Bloomberg on Ford, basically tying them to the aluminum at a plant in, I think, Brazil, that Novo Nordisk runs. I believe that's who's running it. And they've done the same thing with indigenous peoples that Chevron has done and that a bunch of the oil majors have done, which is not treat them particularly well. Not doing the high-tech, high-end cleanup of a refinery smelter down there, and it's polluting the area and people are getting sick. So for the same reasons that I always had a hard time investing in Chevron because I thought they were dirty, creepy people. Novo Nordisk is doing the same thing. It is the age-old story of imperial power and abuse and inside dealing with the governments and whoever else is down there. It'll get fixed. Now that Ford is aware, I'm sure that they will pivot somehow. The same story is going to come out on all the other car companies too, and how they get their aluminum and other resources. So just expect that. Those are great ways to get into these stocks because they usually go down a little bit and then they come back when somebody announces, okay, we're going to fix it, which they should, but it's just the nature of things. Intel, they cut their dividend. That had been baked into the share price apparently for about a year or maybe a year and a half. So now they did it and the share price barely moved. I think that's pretty reassuring. So I would keep going after Intel if you don't have it. Great one to sell puts on. And when it gets assigned to you, there is still a decent dividend. It's just not as huge as it was. But the growth of these companies, everything ties back into that story. We're waiting out the supply chains to build out. There was just an article on Seeking Alpha about that. Muhammad Al-Arian's been talking about that. All the things that are in the news right now that are becoming the narrative about oil inflation and supply chain inflation. And I've been telling you that for well over a year and a half now. So now that it's the narrative, you should start thinking about what the next narrative is. And the next narrative is going to be that growth is important. So you're only going to be able to invest in the companies that show some growth. I just had somebody tell me they're going to 100% income-based strategy. Whatever. First of all, It's a bullshit theory with a bullshit narrative and a bullshit way of selling it to you. The companies out there that pay out big dividends, if they don't have growth, the dividends go away and then the share price collapses. Bottom line, no other alternative. That's the way it is. That's the way it was. And that's the way it will be. So all the folks who are saying, oh, look, 9% dividend. Oh, look, 11% dividend. Oh, look, 8% dividend. Zero growth, high debt. You're screwed. I mean, I feel like you're screwed right now because you're like, oh, I don't need any growth in my portfolio. I'm 72 years old. I'm going to live to be 90 something. And I just need to get income off of this. But what happens in the next 4 or 5 years as these companies have to refinance their debt? We've been talking about it since 2020, that in the middle to the end of the decade, there's going to be a lot of debt coming due, and it's going to be at higher interest rates than what was issued at the first time. And these companies without growth are going to have a problem. They're already starting to see it. The signs are already there. So anybody fighting that is making a mistake. And I say that in the most diplomatic way possible. So focus on the growth and the value of the assets underlying a business, where you are going to get burned. Period. End of story. Always has been, always will be. Suckers in, suckers out. Find the companies with growth. They're sitting there right in front of your face. And then find the ones that have the right balance sheets and the right management, and you will make money over time. And because people don't believe things until it's been known for a long time, you get a chance to make all sorts of premiums selling options against the volatility. This is not rocket science. You need to go back to when you were a kid and you started hearing older, wiser people say things that became stories or became sayings that you've heard over and over again. Kirk, if you really want to know how things work, follow the money. See what the big guys are putting their money into. I got that advice around 20 years old, and it is proven to be true over and over and over and over. When people ask me, well, why is it going up today? Why is that stock going up today? I got to buy it. I don't know how many more times I have it in me say, shut up. If you're not a great trader, don't try to trade. And if you don't know what makes a great trader, then you're not. And look for value and growth when it's cheap in the stock market, because that's what wins. That's all that's ever won. That's all that ever will win. There are some absolutes, and buying things for a very high price because it's been going up for a while is usually a bad idea, usually quickly. There are the extremely rare cases where something like Apple goes up for a decade. But even back in 2012, I wrote an article, might have been 2013, I'd have to pull it up again. I said, hey, Apple's down 50%. It's not rotten. Here's what the future lays out for it. And I went through Apple Watch, and I went through music, and I went through services and everything else. And people said, nah, Apple's a fad. It's going to lose. It doesn't have enough market share, blah, 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 fucking blah. And here we are a decade later, and it's to the moon, and it's been going to the moon for a decade. It's finally starting to pull back a little bit right now. And if it gets down to around 100, you're going to want to buy it because they're sitting on a mountain of cash. They have sustainable growth pushing 10%. They're paying a dividend. They're buying back shares. And they have one of the most stable companies in the world as a major investor that's not going to sell. They trim around the edges and then they add back in Berkshire Hathaway. Other than stories like that, and there's only a handful, stocks go up because at some point they got cheaper than the business model would indicate. And it happens because 4 out of 5 investors are just very bad at investing because they have recency bias and they try to trade into something having no idea how to get out of it. That's why I don't interfere with Shooter, because he's an elite trader, and the people who are trying to trade with him learn quick or they bail. And a lot of them bail because they just don't have the time. Being a good trader really is, at least a 3/4 time drop. I mean, you got to put, at least the market hours into it. And that's why I tell people, look, if you have a living that you're making money at and you're trying to be a trader too, you're going to fail at one of those two things, or you might fail at both. You can use good till cancel orders that you put in once a week and you tweak several times depending on how hot on the trail you are on something. And that's it. You can manage your money by reading however many hours you have available to read, plus tweaking your portfolio for an hour or two a week. That's it. If you're sitting there looking at a screen and you're not an elite trader who's doing it 30 hours a week, then you should go all the way back to 1 to 2 hours a week plus reading. Put in your limit orders, review your portfolio, tweak your orders, and this is how you do it. You take a look at your short list of great companies and you figure out how cheap I can get something roughly, because you'll never be perfect. If you try to be perfect, you get in the way of excellence, and you learn a few mechanical tools like rolling out an option. Every now and then you have to do that because the stock price went 30% lower than what your strike minus premium was. But if it's not 20 or 30% lower, just take possession. That's pretty darn close. Now, I am in the process of updating the rest of these orders. I just have to change the dates on most of these. The numbers are right. Just pushing most of these out to April and May. And I wanted to tell you about something I'm doing with the ETFs. So I am starting to do 401k plans again. I'm just about to book my second one. And I've been going through the ETFs that I'm going to use. And the platform I'm using is called Employee Fiduciary. And they allow me to pick out really any ETF or mutual fund on the market. I mean, it's like 99% of them they got. So I've put together a plan that I'm going to use as a template for other companies. And it has BlackRock's LifePath dynamic portfolios, 20, 30, 40, 50, and 60. And these are the default portfolios based on people's age. Then I have some major index funds and then a bunch of other ETFs. And I've avoided country and industry ETFs except in a handful of cases. But what I'm doing here is for people who aren't going to be looking at their portfolio and managing it a lot, or they don't really know how to pick these out. Well, Kirk, which one should I own? Well, if that's your question, then just let Kirk manage it. So I've put the Blue Mountain Growth in here because Employee Fiduciary allows me to manage an asset allocation. So between the lifestyle target date funds over here at BlackRock, and the reason I picked BlackRock is because they have more information than anybody else in the world, and they're pretty good at using it. They're the biggest ETF company and money manager on the planet now. And these funds have outperformed in general. If people want to set it and forget it, they can pick this. If they want to go half set it and forget it, they can pick me and BlackRock, or 20/80 or 60/40 or however they want to do it. If they want to have 25 or 50 or 75% of their portfolio just indexed to the S&P 500, then give me a little bit, they can do that. But the thing I'm discouraging most people from doing is trying to manage the bucket. Because again, if you're not doing it at least 3/4 times, you're probably going to screw up, right? So I have gone through the ETFs again. I've added a few. You're going to see these on the plug and play. You're going to see the very short list get shorter for the ETFs because I'm going to start giving you my trades in that Blue Mountain Growth portfolio. And that will become the new Global Trends ETF. So when I make a trade in there or have an asset allocation change, you'll see it. One of the funds I replaced was that Frontier Markets, the technology and e-commerce, similar to the EMQQ fund. And I replaced it with the Freedom 100. This is an ETF that's 10 times bigger. So it actually had some traction, liquidity, and it looks like they'll have an option market at some point. FMQQ just wasn't growing, so I replaced it. And what I'll do for you with these is we'll do the global trends update every month, as we have been doing, and I will show you the current asset allocation for Blue Mountain Growth / Global Trends ETF. And the only real change that you're going to need to make is if you're retired, I'm just going to give you a couple of extra funds to swap out. But for the most part, if you're in ETFs, you can be pretty aggressive because you're nicely diversified. And again, all you have to do is figure out how much do I want in cash in the short run, 10%, 20%, 40%. So I picked out these funds based on a number of things. One, performance. I wanted to see who is performing well. So I took a number of comparisons and I just compared them to other funds. So like here is the emerging markets small cap versus the emerging markets small cap dividend. And recently, since the COVID bottom, emerging markets small cap has outperformed the dividend side. Historically, we know that goes back and forth. I expect the dividend funds to outperform as interest rates come back down. And I believe that interest rates are going to pivot sometime this year. Because again, as I started at the beginning, the narrative has shifted to people talking about what we were talking about a year and a half ago. Inflation is not monetary phenomenon right now. It is being caused by choked up supply chains and energy. And both of those things are resolving. It's not going to resolve overnight. It's going to take another year or two, but it's coming. So as we get past the summer driving season, so 6, 7, 8 months from now, supply chains will continue to have been built up, right? Factories being built, things like that. The shipping industry is pretty much resolved itself. You're not hearing about the ports, not being unloaded anymore. Although shipping rates are higher by contract, and that will gradually come down starting in the next couple of years. So I don't like shipping companies anymore. If you were going to buy them, you should have bought them off the bottom when everybody said they're going to sink to the bottom of the sea. And now that they're up 300-400%, don't ask me if you should be buying them, because my response is, FOMO, are you a good stock trader, FOMO? And if you're not, then don't do it. You can find things that are cheap today that in a year or two will not be so cheap. Sometimes it takes time. But when you buy things cheap and you're pretty convinced about their future in the long run, the calendar works for you, not against you. Does it matter to you if you make 0, 0, 0, 0, and then 300%? Or do you need it to be the same amount every year? Lumpy is good. It gives you opportunities. So anyway, I picked out a number of these funds. Somebody asked about EPI, the India earnings fund by Wisdom Tree. So I've been comparing the different funds out there. And normally I wouldn't want to do a sector fund or an industry fund or a country fund. However, there are exceptions. So with the Wisdom Tree India earnings fund, I just compared it to the INDA fund, and it's slightly outperformed, and it makes sense. And the factor-based models, the simple factor-based models, right? The ones where somebody says I have 75 factors or 100 factors, shut up. You don't even know what you're looking at. But when you find 3 or 4 or 5, maybe 10 easy to use factors to try to figure out what gives a group of stocks an edge, you're usually going to get a small edge. And when you include things like momentum, you get a little bit of systematic trading that will usually, not always, usually be in your favor. So if we can beat all these benchmarks, all these indexes by a couple points on a consistent basis, not always, but usually, you're going to do well over time. The compounding will work for you. So I've picked out all these funds based on how they performed, what I believe about underlying factor and quantitative analysis. Basically, my theory on quantitative analysis, and remember, I've been doing this since the early 2000s, is that simpler models are better. The more factors you put into your model, the less likely the most important ones are going to give you an edge, because you're weighing them down with too many ingredients in the soup. Your best chicken noodle soup has like 5 ingredients, right? How many soups have you eaten that had 100 different things in it that you were like, oh, that's delicious? No, I want chicken dumpling soup. I want chicken. I want dumplings. I want broth. I want a little celery and some spices, right? Same way for quantitative analysis. And that's why when people ask me about the ratings at Seeking Alpha or any other website that does quantitative analysis, I always say, how many factors are they using? Well, I don't know. Well, you should probably ask. You should probably get that information, because if they're using a double-digit number of factors, it's probably too much, and it's certainly too much anytime it says, "Oh, we're using hundreds of factors." Shut up. Shut up and just use the soup analogy. Even a good chili's probably only got 6 or 7 ingredients, right? Got your meat, got your tomato paste, got some diced tomatoes, maybe some chicken broth if you don't want to use water. That's what I do. Beans, meat, peppers, onions, right? 8 ingredients, 9 ingredients. So when you take a look at ETFs and you're seeing this wave of new products, factor this, factor that, quant this, quant that. Simpler is better. And take a look at the 3-year track record if it's newer. Only one of these funds doesn't have a 3-year track record, and it's the Freedom Fund here, the Freedom 100, mainly because it's easy to understand. Take a look at it. It's easy to understand. It's 100 stocks, give or take, growthy, and they don't invest in countries that are despotic. Now, you can use something other than this, but because I use this, right, has to do with my portfolio construction. Because I have a fund with China, I wanted a fund that I knew wouldn't have China. So these two are complements to each other. There's other ways to do this. I just choose to do it this way because this is an incredibly tradable fund, which today on an up day, if your portfolio, if you're up 30-40% on this fund, because we bought it, we bottom ticked it, or 20 some odd percent right now, and your asset allocation's out of whack, go ahead and trim it if you want it, because today's an up day. I sold a little bit Friday, or Thursday, I sold a little bit today, just maintaining asset allocations. You can do the same thing. I will say, I believe in general, the dollar is probably going to start coming down after Labor Day. Between now and then, hard to say. You don't know what the Fed has got to say to fight oil inflation. If Russia screws things up, OPEC screws things up, or China ends up running a hot economy. But we know that at some point the Fed has to back off, because the US government can't afford these higher rates for a very long time. And they get these windows like a couple of years ago where they refinanced out the US government in the longer bonds, and that gives us a little bit of opportunity to have higher rates for a while. But when those other US government bonds start coming due in a couple of years, I believe there's a big slug of them in 2024 or 2025. I'd have to double check. But at some point, when the US government bonds come due, the rates have to come back down. So what did we talk about a couple of months ago? There's like $6 trillion, $7 trillion of US debt between this year and the next 2 years. And I think it's kind of backloaded. I think it's 2, 3, and 3, or 2, 2, and 3, something like that in trillions. I'd have to double check. The point is that the Fed knows this. So either foreign money has to buy those bonds, or the Federal Reserve has to pay those bonds, or we have to run a balanced budget. Well, of those three things, which is the least likely to happen in the next few years, right? We're not going to run a balanced budget in the next couple of years. I think it happens eventually, but I think it has to do with the boomers being less of a burden down the road, while the millennials are still earning. So in the 2030s, I do think we get to a balanced budget. I think we even run some surpluses. A lot of this has to do with energy. Most of it has to do with demographics. And the fact that, for whatever reason, in the last 40 some years, we've given massive tax breaks to the top 1%. And those loopholes probably have to get closed. So one of the things that I am starting to get pretty warmed up to is buying GLD again. And what was the story back in 2020 when I told you that we were going to go on a long-term gold bull market? Initially, the stocks would do the best because everybody was going to be hyped up about increasing production of gold in an environment where the dollar was getting cheaper, within its range. And now it's probably in a higher trading range, but that we would morph into a period when scarcity of gold simply became the major story. And we are pretty close to that. Do you know what the uses of gold are? How much is jewelry? 78%, give or take. How much is industrial? About 12%, give or take. And how much is all financial transactions using gold? About 10%, right? All the ETFs, things like that. A couple people have bought oil with gold. A couple countries have bought oil with gold. So 78% of gold is used in jewelry. And that'll probably come down 1% or 2% over the next several years as the industrial goes up 1% or 2%. So the demand for gold is relatively constant, but the supply is going to start coming down. Pretty simple Econ 101 equation there, right? So the gold ETFs, based on the price of gold, are going to do well because supply is going to be constrained, just like we've seen with oil recently, right? While the demand remains rather constant. The difference between gold and oil is that the demand for gold will probably stay constant forever and drift upwards as population expands a little bit. And I'm sure the aliens will like it. Got to give them something when they get here. First contact's in 2062, folks. But oil we're replacing. So gold's not going to get replaced like oil has or will be. So I'm starting to warm up to buying physical gold. Somebody asked me about it today. And as I always say, if you can find some gold coins at a fair price that you intend to hold for a very long time, maybe give it to your kids or grandkids, which is my plan, then find some cool gold coins. And I would go for older ones. If you can get your hands on coins minted decades ago, or somehow get your hands on coins from the 1800s, right? If those coins are in your family and people are talking about inheritance, you claim those. Don't care about the car. Unless it's a classic car that you can keep in a garage long term. Easier to store 50 gold coins than, a Mercedes-Benz or a Corvette, unless you have extra garage space. So I do like gold. That's why it's in here. The water resources, if you're paying attention to what's going on in the Southwest United States, you're starting to realize there's got to be some solutions for the water equation. And the companies that help with those solutions are going to do well. I'm not positive this is going to be something I'm in, on a regular basis, but I think there will be a FOMO on water stocks at some point. Technology generally is what you want to overweight. I wouldn't normally do an industry fund, but semiconductors is one of the best ones. I don't have TAN in here because there's a lot of overlap with these clean energy funds, large cap, global, and small cap. And if you take a look at the correlations, there's some very close correlations. So you don't really need TAN. A couple of these funds are pretty loaded up on the solar. And then you can parse it out based on market cap, later early in the cycle, depending on whether you want to go small cap or large cap. You know, this one, of course, is heavy in Tesla. Tesla has some interesting news coming out March 1st. I'd be very interested to hear what part 3 is of Elon Musk's plan to change the entire world. I think Elon Musk is getting to the point now where people have grown weary of him, and I'm not so sure he still has the Steve Jobs effect. I'm not so sure that what he says will be met with the enthusiasm in the stock rallies of the past. Maybe, don't know. But if Tesla starts to monetize the ideas better, and you know they have tax breaks at their back, then Tesla, maybe they go back to their highs. We'll see. I think it's at the high end of what should be its trading range, but that doesn't mean that it will be its trading range. All right, so let's call it a day. I have a couple of errands to run. I will get this cleaned up and published tonight. I will get the ETFs updated. The global trends ETF, very short list will be updated. So we have a lot going on here in the next several days. A new plug and play stocks in a month, but I have added a couple of companies. I will tell you that I am researching Rolls-Royce right now. Very interesting couple of things they're doing, from small nuclear reactors to hydrogen jet engines. I don't think either one is here in the next decade, but the question is, how will the stock behave between now and then? So we'll see. All right, have a good day, and I will get at least one article out tonight, if not